Welcome to It's the Economy. The Reserve Bank policy of last week shook the market with its jumbo 50 basis rate cut and a totally unexpected 100 basis point cut in the cash reserve ratio. That, of course, starts from September. However, the governor moved the stance back to neutral from accommodative, signalling probably there's very little chance of more rate cuts. The Reserve Bank cut the inflation forecast for the year to 3.7, left growth forecast unchanged at 6.5, which anyway is above consensus. Today we have in the studio an economist who is a member of practically every key policy-making body in the country. Joining me is Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India, member of the Finance Commission and member now of the Prime Minister's Economic Advisory Council. Well, he is also member of several committees of the Ministry of Statistics that are revamping the IIP, the CPI and GDP. So we really have someone who has a hand on every aspect of the economy. Soumya, thank you very much. Welcome to our studio. I don't think we have interviewed you in the studio, so thank you very much for dropping in.
Thank you.
Okay, let me start with with the policy itself, though I want to ask you economy questions. Would you say this is the terminal rate, with the governor saying there is very little space, as well pulling the stance back to neutral?
Yeah, thank you, Latha, for having me on the show. Now, I think as per the conversation which the governor had post-policy, he clearly said that the monetary policy has done enough to uplift growth. So from that perspective, it looks like this could be the terminal rate. But my sense is that I think if food prices remain within control, given the fact that RBI has cut the inflation forecast to below 4%, and even next year if the inflation is going up, it will continue to stay between 4 to 4.5% range. I think if the inflation behaves properly and if there is some disappointment on the growth outlook, I think there is still some marginal window to cut the rates. It is difficult to say whether it could go to another 25 or higher than that. But we are possibly towards the end of the rate cut cycle. Okay. But we are not yet there.
Okay. So your base case is terminal rate is 5.5, but a small possibility of another cut?
Small possibility of another cut. Maybe in the not in the August policy, but maybe beyond that.
Beyond that. Okay. You said if growth disappoints. Is there a chance at all that growth will disappoint? Because we've got fairly decent numbers for the fourth quarter, in fact, better than expected. And now with this double cut, and once the double cut is over, the CRR takes on, is there a very good chance that growth will surprise on the upside?
Yeah, I think the fourth quarter number, actually the good point is that the fourth quarter number actually has surprised on the upside. We are all expecting, actually, the market was expecting a very good growth number because of the
6.8 on GDP and 6.5 on GVA.
But the good thing is that the GVA actually has also surprised on the upside, 6.8%. So from that perspective, I think the growth numbers have not disappointed. And the first quarter of the current year also, I think you know that the issue is basically the geopolitical conflicts. Every day is a new uncertainty in the era of the markets in terms of the conversation, in terms of the way the trade deals are moving up. So my sense is that as of now, 6.5% growth projections which the Reserve Bank has made at some point of time has lowered from 6.7%, looks a possibility that we may have to, we may agree with. Earlier, there was some...
The consensus I got was 6.3.
Yes, but now
RBI stands at 6.5.
Yes.
So do you think
I think there is now
will upgrade?
I think there is now a larger, after the first quarter numbers, there could be a larger probability of the growth actually converging towards 6.5% or more. So from that point of view, I think the growth numbers may not disappoint, but you have to keep the window open. You need to understand that there are geopolitical conflicts. You also need to understand that the monsoon could be a little days of scarcity in monsoon could actually put the food prices up. As an example, I think after the pre-monsoon showers in the end of May, there has been a shortfall of around 20-25% across India. So these are moving things. So my sense is that yes, we are on the course of getting closer to the RBI projection of 6.5%, if not more. But we have to be cautiously optimistic that this has to be sustained.
What's your own number?
Fiscal. My number as of now, we have not revised it upwards. We're at 6.3%.
Okay, but you think that there is
a possibility of an
it?
upside to it.
Okay, okay. But what about credit growth itself? The policy has done so much for it. Besides the repo cut, which of course this is slack season, but once the busy season begins, you have this massive CRR cut coming in. Will that mean what is the credit growth forecast?
See, I think with a nominal GDP growth rate of around 10% or below, the credit growth forecast, even if we assume and multiply for 1 to 1.1 or 1.2, should have been closer to 10 to 11%. That was the earlier consensus. So the central bank purpose is that to make the system abundantly liquid, continue with a liquidity surplus regime, announce and pre-medicated CRR cut so that the banks know that where they will be standing for, and there is also, if somebody is willing to invest, that also is front-loaded. So my sense is that if there is demand comes back, most probably the demand, it will be led by the retail credit growth. I think it could be around 12 to 13% overall. So from there could be a 1 to 1.5% difference, because the estimates show that if the cut in the CRR allows 2.5 trillion lendable resources, and that could have a 1.5% impact on the credit growth. So even if the impact is 1.5% or even 2%, the credit growth moves up closer to 13%, which in itself I think will be could be possible to support a growth rate of 6.5% or beyond.
Okay. Now comes my worry. You know, there is this huge amount of 2.5 trillion coming, and as your latest report said, the money multiplier may be even 6 times. So we are going to see the CRR cut having a multiplier effect on loan growth or deposit growth. Is there a possibility that we will spark financial excesses, asset inflation? Because as you said, nominal GDP is 11%, but credit growth grows way above it at 13 or 14% because of excessive liquidity and CRR cut. So will we end up driving up asset prices?
No, I think regarding the first point of asset price inflation, yes, there is evidences that there is a liquidity. You have seen also in the last year, the markets actually have ran away. But I think in the Indian context, the link between asset price inflation and monetary policy the monetary policy feedback loop is not that clear, because in India, even after you have so much amount of demat accounts, the number of people actually investing in the financial market is not that, not significantly high. So from that point of view, the asset price inflation, like in developed markets, which has a very good monetary policy feedback loop, that may not be as strong in the Indian context. So that's point number one. The point number two is that I think the important point to note about this CRR cut, I think, when in a rate cut cycle, and given the fact that deposit rates are going to be cut by many of the other banks, we're in an EBLR regime, that actually, the CRR will actually act as a cushion, because there will be fight for deposits in a lower, if the rates are lowered, obviously the banks actually will have not much incentive to leave the savers. So in that point of view, the CRR could act actually as a buffer of ensuring that even in a declining deposit growth rate scenario, the lower reserve money growth which is happening is not translating into a lower broad money growth. Because the other important point in the last 4 years, the 70%, the growth in the reserve money has declined from around 18% to around 4.3% last year. And 70% of that is attributable to the lower currency leakage, so increasing digitization. So I think all these are actually acting as buffers to push up the money multiplier, and that will help to ensure that the money supply growth is at least equivalent to the nominal GDP growth rate, or if not more.
Okay. Now let me come to, you said when you were referring to credit growth, you said it will be largely driven by retail. How confident are you of capex? I'll tell you the worry for the current GDP forecasters. One is the tariff rate, the tariff war. But the other is also that the government is now done enough for capex growth. This year, they have their eye on fiscal deficit lowering, so capex is not pushed up so much. You have gone to a lot of states, you've gone through the states' data. Do you think states will pick up the capex baton, or do you see private sector, since you are anyway heading, at the helm of a large bank, you see private capex picking up the baton?
See, I think I'll give you an interesting anecdote over here. Last year also in FY25, I mean, the 6.5%, the 7.4% growth in the last quarter and an overall 6.5% came growth in largely often on the back of an back-ended capex. If you remember, from April to September, the capex growth actually was quite low. And from September to March, when after the government changed a lot of rules regarding that 1.5 trillion interest-free capital loans to the states, it did pick up. And the center also actually went on an capex overdrive. So ultimately, I think it was able to meet almost the entire target, which was around 11 trillion, which was in the last budget. So from that perspective, my sense is also is that this year the capex growth is likely to be a little more back-ended. So if it is back-ended, and that's why I think the timing of the CRR is an interesting coincidence that you are putting the CRR cut at a time on a staggered growth rate whereby the busy season starts and there is a possibility of the back-ended capex available. So my sense is that as of today, yes, the capex cycle looks a little bit on the thinner side. There has been a survey of NSO which says that it's not likely to be as strong as last year. But my sense is that if it is back-ended, the way it happened last year, and the states take up the baton as they have taken up, then I think it could be good for the economy.
So you think government capex will pick up in the second half?
Yes, it will mostly pick up in the second half because I think by that time we should have a clear idea about the trade deals which have come through, the India-US trade deals which have come through. So if it comes through, I think the markets will have the clear bit idea, and hopefully more of back-ended capex in the second half, and that pushes up the growth.
Okay. Well, actually, we are out of time, Soumya. I wanted to ask you about the new CPI IIP numbers, of which you are a committee member. You expect it to dramatically change?
No, I think the new CPI actually the measure. I'm a member of the IIP committee, so at least I can talk about the IIP. But IIP, I think there has been a lot of revision. Already they have reduced the time lag of the data. And I think they're also trying to do some innovations. Okay. I mean, the committee is doing
by way of collecting data.
Collecting in terms of, so I think the data collection actually could get a huge boost in terms of all the initiatives which the government is doing.
Okay. I'm sorry, out of time. We're not out of questions. We will get you on another day. Thank you very much for joining us. So that's the word coming in. Capex growth, especially from the government, could take a leg up in the second half when the CRR cut will also come in. So we should have a boost to growth much more in the second half. We have to wrap up on Bazaar on that note after a break. Chartbusters.